QuickBooks Online 2025, entering a deposit form, increasing the checking account, decreasing the clearing account, which was impacted when we entered sales receipts and receive payment forms. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 project file we set up in a prior presentation, opening the major financial statement reports as we do every time. The reports are on the left-hand side within the Standard Reports tab. Under the Favorites, right-click in the Balance Sheet to open a link in a new tab. Right-click in the Profit and Loss to open a link in a new tab. Tabbing to the middle, we're going to be closing up the hamburger, changing the range to that 1 month time frame. 010125 tab, 013125 tab. Run it so it can refresh it. Tabbing to the right, closing the hamburger, changing the range. 010125 tab, 013125 tab. Run it so we can refresh it once again. Back to the balance sheet. Quick recap of what we've done thus far. Entered or started up our new file. We then entered the beginning balances from a prior accounting system. We then imagined transactions typical to starting a new business, that being the need for money, for capital. So we made 2 deposits, one from the owner, one from the bank to take out a loan. Once we had money, we bought equipment, property, plant, and equipment to help generate revenue in the future. Then we also bought inventory so we could sell it to generate revenue. Then we were finally able to make some sales. The 2 types of sales reports we have, if I hit the plus button, are going to be the invoice, which is a sale that happens on account. You might hear from a textbook, on account, for example, in which case we didn't get paid at the same time we did the sale. For example, in a law firm or CPA firm or landscaping situation, that might be the case, for example. Or if you have inventory, some cases you might actually ship the inventory before you actually receive the revenue, depending on the circumstances. And then we have the sales receipt form, which means we got paid at the same point in time. Now note, whichever form that we use, we run into this problem of grouping how we're getting paid and when that money is going to hit the checking account, noting that if you've learned bookkeeping and accounting from a textbook, they often skip this point, and you want to really focus on it because logistically it's very important in an actual accounting system. So let me show you what I mean over here. We're going to go back to our flowchart, noting this is a desktop homepage screenshot flowchart. I know we're using QuickBooks Online. This is just to show the flow of the forms. So here's the problem. Even if I have an accounts receivable happens, or invoice happens, accounts receivable goes up, and then we have to receive the payment on the accounts receivable. The question is, how are they going to pay us in real life, logistically? They could give us cash. They could give us a credit card. They could give us an electronic transfer. They might pay us through PayPal or something like that. In a book problem, all of those things, we just call them cash and cash equivalents. So in a book problems, we would just increase cash. I don't care what kind of cash. It went up. Cash is going up in some way, shape, or form. But we can't do that in actual accounting system because it's important to know which cash is going up, because I need to track the stuff that goes into the checking account in such a way that I can verify the checking account with a bank reconciliation, possibly with the use and help of bank feeds, so that we can tick and tie what we have on our system to what is in the QuickBooks system. Now note that if we're using an invoice, we can't simply rely on the bank to record all of our transactions because we're going to have this accrual component. So that means that when we get to this received payment, we might have to put it into a clearing account, because the credit card company, for example, if we get paid by credit card, will group the payments together, and when they put it into our checking account, it's not going to be sale by sale, but in some kind of group, and they might take a fee out of it. So that means that we put money into a clearing account in order to deal with that. Similarly, if you're at a cash register, even at a cash register on a cash-based system, you might not be able to record all your sales by waiting until they clear the bank account, because you want the internal control of matching out the sales that you make in the system to the money that you have in the cash drawer, for example, and therefore you run into the same problem. If I get paid with cash, I'm going to group the cash together and then deposit it into the checking account as a group lump sum. Or if I get paid by credit cards, the credit card company, once again, is going to group the payments together and then put it into our checking account in some type of grouping, while also taking out a fee that we're going to have to deal with. How do we deal with that? We insert a clearing account, which used to be called undeposited funds. Now it's called like payments to deposit or something. And that's what we did in prior presentations. So I'm going to close this out. So if I go back, for example, to our prior tab, our first tab, into the sales area, for example, and then I go into my all sales. I'm going to close up the ham boogie, and let's take a look at the sales receipts. So within the sales receipts, let's edit one of these items so I can look at the transaction, and we can see down here that we put it into not the checking account, but rather in this clearing account called payments to deposit. So I'm going to close this back out. So that means if I go onto the balance sheet, I now have this account on payments to deposit. Now note that that is basically a cash account because it represents either cash that's in the check register or cash that we have claimed to have earned but is in the third-party financial institution at the moment of the credit card company who helped us collect the cash, or maybe it's in another third party like a Stripe or some other kind of online payment system that we have. You would think it would be under here, under a textbook. Remember, a textbook would just have one line item for the balance sheet called cash and cash equivalent, that would include everything that's cash, cash on hand, cash in the checking account, savings account, so on. But here we have this sub account that's breaking out the checking account, which we need because I need to track everything by checking account so I can reconcile. This account you would think would be up next to it, but it's not because functionality-wise, I don't connect it to the bank feeds. Therefore, it really acts like an other current asset account. That's why it's down here, which is a little bit wonky. So that means that basically whatever's in this account, then I want to transfer it as I go to the bank and put it into this account. So we imagine now we have the money in our cash register in our example, or similarly, you can imagine that it's in the credit card's financial institution. We're now going to get our bouncers. We're going to pack ourselves up so no one tries to rob us as we make our trip to the bank, taking this money and putting it into the bank. As we physically put it into the bank, then we want to make the transfer in the same grouping as will go into the checking account. Now, QuickBooks has this nice ability to do this in the deposit form. So if I go to this first tab and we hit the plus button, we've got the deposit form. Now, remember that when we have a deposit, you might make the deposit sometimes with the help and use of the bank feeds. However, the bank feeds don't really work in this kind of system where you have to use the clearing account because you needed to connect to the clearing account and help you with that grouping situation. If, on the other hand, you were just getting deposits from like YouTube or something as your business, then you might be able to wait to clear the bank to record the deposit. You'll also remember that we entered a deposit before a little bit faster without not using the bank feeds, but rather using the register. So you could use the register, but again, that doesn't really work so well if you're going through this undeposited funds. So what I use typically is I use the bank feeds if I can, and then if it's an easy transaction that doesn't go through undeposited funds, I use the register because it's a little bit faster. And then if I'm going through undeposited funds, I will use the actual form here because it has this nice little bit where it basically breaks out all the stuff that was created through the two types of sales forms, which means the invoice, which then was recorded a received payment, which is the payment form, and the sales receipt. So they're not really the two sales forms, the invoice form and then the payment form. The payment form is connected to the invoice. So we have the payment forms and the sales receipts that are making up the increase to the undeposited funds. So that's nice and convenient because now you can see that this total down here ties out to what we have over here in undeposited funds. And now we could just simply group them together and make the deposit. So let's go back on over and let's imagine we're going to make the deposit on, let's make the date. It's going to go into the checking account. And then the date is going to be, I'm going to say 01/19/25. And then I'm just going to keep it at all stores. So we'll keep that there. And then the question is, how much am I depositing? Now, obviously, if I'm physically making the deposit of cash, then I can go through here and check off the cash payments that I made. Noting also that I might have some payments that were cash payments and some that were credit card payments. And when we enter the data input field determining the payment method of cash or credit card, this is where that comes into play and could be useful, right? So I can choose the ones that are the cash ones because that should tie out to the deposit I'm making. And then I can choose the ones that are credit card ones, which I might have multiple different credit card ones, which will allow me to tie out to the deposit that's going to be coming from the financial institution into our checking account. So I'm just going to imagine this time that we pick two of them, and we'll do a couple of these. So I'll pick these two, and so we're gonna make the deposit of this 8,000 and this 5180. And so then let me fix this. Let's actually do the string music, not Smith guitars. So we'll do these two, string music and Sam the guitar man. So that's going to be the 757085. So notice down here we could also make a deposit by just selecting an account. So remember, my general rule would be if I'm just selecting an account, I might not go directly into the deposit form, but rather go into the register or possibly wait till it clears the bank feeds and record it with bank feeds. But if I made the deposit, if it's in undeposited funds, meaning it has the payment form or sales receipt, that's when I can go in here and use this nice grouping system. Now note that if it was a credit card, the credit card might take a fee out. And that's a common question people have. They're like, okay, look, how do I deal with the fact that the credit card took a fee out? So now my actual amount that hit my checking account is like $5 less than this because they took a $5 fee. Well, you could go down here into the account and call it bank fees, right? Or something like that. And it would be a -$5. And now when I make the deposit, these two are grouped together properly, but we decreased it by the $5, which is now going to go to the credit card fees. So this is another nice little way that you can take care of that whole kind of problem by using the clearing account. So I'm going to close this out though. We're not going to be doing the fee. What's this going to do? It's a deposit form. That means it's going to increase usually the checking account. And then the other side is going to be going into the undeposited funds or the payments to deposit, lowering the clearing account. When it goes into the checking account, it's going to go in there as one lump sum because that's the amount that will be in the bank and therefore on the bank statement, making it easy to reconcile. Whereas on the clearing account, it's going to go in there one at a time because that'll make it easier for us to tick and tie what has happened in the clearing account, seeing it go up and then down. So let's see what that looks like. Let's save and close it. So we could print it, we can make it reoccurring and so on, but I'm going to save and close it. And let's go to the balance sheet and check it out running it. And let's go into the checking account to check out the checking. Check it out, the checking. So we have that one lump sum deposit. If I go into it, boom, takes us back to the deposit form. So there we have it. So we're going to close that out. It went in there in one lump sum. That's great because I'm going to match this out to what happens on the bank statement with the bank feeds. Then if I go back on the clearing account, the payments to deposit, going into that detail, notice here it put them in there one at a time. That's actually nice because that easily allows me to tick and tie. In other words, if the clearing account doesn't clear, it doesn't go back down to zero, I'm going to have to figure out what went wrong. Where is the problem? It's going to be easier for me to figure out what went wrong if they tie out one at a time. So I can tick and tie this out, tick and tie that out, as opposed to having to add things together to see the increases and decreases. So QuickBooks has a really good system of that particular kind of problem. Now, just note that if I go back to the first tab here and we go into the ham boogie, and we go down to the transactions, then if I was to have the bank feeds on, the bank feeds would come through here automatically as it hits the checking account. Now, we already entered the deposit, so the bank feeds aren't going to record anything new, but the bank feed should be able to recognize the deposit by dollar amount and date to help us to match out the deposit, helping us with the bank reconciliation process. So the bank feeds still could come into play, still could be useful to us to help us to reconcile, although not recording the transaction in this particular case. Okay, let's do the next one. I'm going to go back up to the balance sheet. So now we have in the payment to deposit, another $20,500. We're just going to deposit the rest of them into the checking account. Imagine that we grouped them together at one lump sum deposit as well. Notice that nothing's happening, by the way, on the profit and loss or income statement, even though we're depositing money into the checking account. Why? Because we already got the money. We already recorded the revenue in the past, either with the invoice or the sales receipt form. So let's go back to the first tab and let's hit the plus button, which is over here now, and go to the bank deposit. Let's say this happened, checking account, let's put it up to 121. And then we're just gonna check out all the rest of them. So I'm just gonna hit the thing up here, which does it all at one time, saving me 2 clicks. This video is gonna be that much shorter than the normal long videos. Why? Because I saved myself 2 clicks right there. You add those things up, time, and it makes a difference. So then again, if it was going through the credit card, then we can add a credit card fee. If that was the case, what's this going to do? It's a deposit form, so it's going to increase the checking account, typically the checking account. The other side's going to be decreasing, in this case, the clearing account, which used to be called undeposited funds, now called payments to be deposited. The amount in the checking account will be at one lump sum, $20,500, because that's what I expect to actually be on the bank statement, making the reconciliation as easy as possible. But the amount that's coming out of the clearing account, which used to be called undeposited funds, payment to deposit, now will be in there at one at a time, allowing me to easily tick off the increases and decreases to that account now having, or should be going, down to 0. Let's save it and close it and see if that is indeed what is done, dude. Back to the balance sheet. Let's run it. And then we'll go into the checking account to check it out. Check in the checking, check in the checking. And there it is, one lump sum deposit, $20,500 for the amount that we expect to be seeing on the bank statement. Closing that back out and then going back, and then the payment to deposit. Notice it went down to 0. Now you might be saying, hey, look, why, if it went down to 0, is it still showing here? Because maybe you don't want to show it here when you do external reporting. But QuickBooks typically by default will show it here if there was activity in the account. Why? Because for internal purposes, I still want to be able to click on it. So it takes me down to the data so I can see the increases and the decreases. So there it is. It's in there one at a time this time, so I can tick and tie. There's the 8,000 increase. There's the decrease. There's the 7. There's the 7.5. Boom, boom. Even though these all got deposited with the same deposit form. And so very nicely and well thought out portion here on the QuickBooks side. Let's go back. Now, if you wanted to get that 0 out of there, turning it off, notice you could still switch to the modern mode. They're still kind of debating whether they want to go to the modern mode or not. But you could say show not active, but non-zero ones, and then boom. And then non-zeros are gone for external reporting purposes. So you might want to save that as the default when you print the reports for external reporting versus internal reporting, where you want the 0 there so you can click on it and see que pasó, what happened. All right, so let's see where we stand. This is where we stand right now. We're going to open the trial balance up shortly, but you can take a look at these numbers if you'd rather see it on the good trusted balance sheet. Income statements staying at the same point we were at last time, done nothing new here. So let's go back to the first tab, and we're going to go down to our reports. Let's open up the trustee trial balance. Trustee trial balance, we'll just type it in there, the TB, trustee trial balance. Trial, I type in trustee. Trustee is not part of the actual name, you idiot, Bob. What are you doing? Okay, I knew that. You just call it trustee because it sounds cool, and it is trust. Okay, I'm going to close up the hamburger. I know it's not really called, there's no trustee. I knew that. I was just felt like typing it for the fun of it. 013125. Let's run it to refresh it. So there we have it. So this is just the balance sheet on top of the income statement. If your numbers tie out to these numbers, great. If not, then you might want to increase the date range to include the current date. And if it changes the numbers, drill down on that change to the numbers to the source document, which might this time be the deposit form, changing the date to the proper date sometime before January 1st, 2025. If there's still a problem, we will run transaction reports at the end of the first month of data input, which might help to track down any further problems. Remember, and this is basically just the balance sheet on top of the income statement without the subtotals. So the assets is assets, liabilities, equity, income, and expense. So if we see how this is created, we have the assets, checking account, accounts receivable, inventory, investments, and then deposit fund down to zero, furniture and fixture, the contra asset account of the depreciation, accumulated depreciation that is, then the liabilities, accounts payable, the Visa card, the sales tax, and the loan payable, then the equity accounts, which we only have the owner's equity, or we have the owner's investment and owner's equity, and then the income statement accounts, which were not impacted this time, therefore staying the same, 10,107 and the 5180 of the income versus the expense, in this case just cost of goods sold thus far, of the 8062. So if I took these two, added them up minus this one, we should then get to the balance on the income statement. That would be the net income, which would then roll into the balance sheet. As we can see on the balance sheet here, it's in net income. If we increased the date to 2026, the next year, then the net income would roll into the owner's equity, which is equivalent to the retained earnings if it were a corporation. If we did that here, changing the date to 2026, these three accounts would go away, resetting the income statement, the balance roll it into owner's equity once again.